Welcome to the Robert Hunt Financial Market Update. It's your favorite host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you, of course, out to make it actionable, understandable, and clear. What a week. What a show. We're digging back into Mr. Peter Mallouk. He's got excellent data for us with updated figures for 2026. So we'll be looking at some of that drawdown data we've looked at previously, as well as asset class returns. I then want to evaluate what some might call a chart crime. Chart crimes are charts that can compel us to believe something with certainty when it really might not be so certain. And then a Warren Buffett parenting advice. So a friend of the show sent me this right before publication, so I had to throw it in. And then we're going to look at artificial intelligence, because we do it every week. We have to. I'm using it every week. I want you to start trying to use it. We're going to be looking at how AI does with certain personal financial questions, how good it is, but then the blind spots it may have. So let's start at the top. Mr. Mallouk. This drawdown data. Every time I look at it, it shocks me. And I'm amazed at how much I don't know or appreciate about the volatility of markets. So in this particular data set, 1950 to 2025, it shows the S&P 500 with the maximum intra-year drawdowns versus the end-of-year total returns, meaning, hey, how far did this thing go down, top to bottom at any given time in the year, versus what was the total return for that year? For example, because I bet you're curious, this is what shocked me. You guys remember COVID. You remember 2020. The total return for that year was positive, up 18.4%. The further I get away from that COVID crash, in my mind, I would have, if you had asked me, Robert, did the stock market go down the year of the COVID crash? I would have probably said yes, even though I've seen this data. So it went down 33.9% that year on the max drawdown, but positive for the year. Positive for the year. And I look at the S&P 500 from, you can go back to 2003. From 2003 to present, guess how many years it's down? Just not the amount of those years, but from the year 2003 to present, how many years had a negative total return? Go ahead and bring the grandchildren in for this one. They kind of want to know it. If you guessed 3, you'd be correct. 2008, no surprise. Many of you remember the subprime crash. 2018, I have no recollection as to why that's down for the year, down 4.4%. And then 2022, down 18.1%. So that's 22 years. And only 3 of those years is down? That's wild. And we can go back to other chunks of S&P 500 history from 1950 to present, and there were certainly worse sections. But wow, we are on quite a run here, listener. Doesn't mean it can't continue, but that is wild, just how few years from 2003 to present we've had total returns that are negative. And when you look back, these max drawdowns from 1950 to present, some of them are pretty sizable, and it just doesn't matter in the big picture. So my takeaway is, no matter the size of the drawdown, in 1987, I bet very few listeners recall that time. I was 2, of course, trading on the phone, I'm sure, too, but the drawdown for that year was down 33.5%. That was the max intra-year drawdown. It was up for the year. Up 5.8%. So this was Mallouk's commentary that I just can't affirm more. The reason why the annual return from 1950 to present, average annual return was 11.5%. The average drawdown was 13.7%. That's the price of poker. When people say, well, why does the stock market give a return at all? It's because it's all over the place. It seems schizophrenic. Its returns. And then a reminder from Mr. Maluk about what assets should be held over the long term. The annualized total return of stocks from 1928 to 2025, 10.1%. 10.1%. And what he does is he cuts it all the way down from 100% stocks to 90% stocks to 80% stocks, all the way down to 100% cash. Annualized return of cash is 3.3%. After inflation, it's about 0.3%. After inflation for stocks is about 7% per year. So it's a tough game. And this is whenever someone wants to time the market or try and rotate in and out of equities and hold a large cash position. It's a losing game over the long term. You're going to have to be right twice to make that. You're going to be right on the sell side, right on the buy side. Very difficult to do. And then I'm going to try to scare you with what I think is a bit of a chart crime. This coming from Mr. Eric Nelson, CFA. He says, how much can a diversified equity portfolio help you in retirement? If you had $1 million in the year 2000 and you needed $50,000 a year plus inflation, you were broke by 2016 if you invested 100% in the S&P 500. He then continues, if you instead invested in a globally diversified stock portfolio with small cap and value exposure, you had $3 million left, 3x your starting amount in 2025, including almost $800,000 more annual spending from 2017 to 2025. Well, what was going on in the year 2000? He's not wrong, by the way. On the surface, he's not wrong. Well, that was peak U.S. growth stocks, basically. That was the tech bubble. And so if you did retire then, right then, you were not in a good spot. However, if you'd started this chart in 2002 or 2003, I bet you'd be just fine. And as much as I think in this instance, they're promoting dimensional fund advisors, which is a kind of an index, they call it factor indexing. They'll take different indices and basically fancy them up and in their minds help you become more diversified. You really don't need it. We could find any date that would probably scare you at any point in time on investing. Knowing financial history is so important to resisting pitches. Because what someone can do is they can go ahead and say, hey, look, if you had started this strategy in 2000, you'd be in bad trouble. And they're picking the very peak of the peak of the peak of the S&P 500. Not the absolute peak, but it was certainly at its high water mark for that time period. And so you get wonky data. Of course, it's possible that could happen again. I wouldn't bet on it. History usually doesn't repeat. It rhymes, but usually doesn't repeat perfectly. So knowing our financial history, because I could go back and I could make all sorts of statements. If I get to choose the year, right? If I get to choose starting in 2008, 2009, if you had invested 100% in beaten down bank stocks and sold 3 years later, you'd be in great shape. That doesn't really mean a lot though for you, does it? So we got to know a little bit of financial history, because I'll confess these sorts of charts can be compelling. We can look at them and say, wow, I don't want to get caught like that retiree in the year 2000 with $1 million only in the S&P 500. I need to be diversified in whatever dimensional fund advisor tells me to do. Yeah, not so fast, my friend. As Coach Corso would say. Not so fast, my friend. We got to know our financial history. And then Parenting 101, I will just tell you, I don't recommend this strategy. I thought it was funny. When Warren Buffett's 3 children were growing up, they did chores every week for their allowance. That's a good idea. Susie, Howie, and Peter, they mowed lawn, cleaned gutters, raked leaves. I'm thinking they cleaned gutters on a first-story home. I really don't recommend letting your children clean gutters on a second-story home. Not a good idea. In their middle-class neighborhood in Omaha, Nebraska, Warren paid them in dimes. Wouldn't you know it, Warren Buffett, he installed a slot machine on the 3rd floor of their home, which required dimes to play. His child Howie said Warren would get most of his allowance back, meaning whatever he paid the kids, he'd make back on the slot machine, and the neighborhood kids would also bring their dimes over. So what was Warren Buffett teaching them while also making some money? Gambling's bad. and I'm teaching you chores. So hopefully the children and their peers around the neighborhood stopped putting money in the slot machine. So I guess the lesson is own the slot machine, don't play in it. I say just avoid it altogether. Gambling is not your friend. We're circling back to Maluk. Before we go to our AI corner. I'm hearing it. I know you're hearing it. Everyone's hearing it. This indexing thing can't last. You ever heard this? Oh, you're top heavy, bottom heavy, middle heavy, too much tech, not enough tech. Whatever. Listen to this. Only 193 of the constituents of the S&P 500 in 1999 are still in the index. Whoa. So the S&P 500 is the 500 companies representative of the American economy. It's our most famous index here in the States. So 1999 to present, they lost over 300 companies from the index, meaning someone else took their place that was doing better, more dynamic, better company. And you might say, whoa, yeah, see, why would I invest? I'll just pick the companies I know will do best. It's impossible. To me, this only affirms indexing even more. I bet there were loads of companies in that index in 1999 that were can't miss. You never would have dreamed they'd fall out of the index. But more often than not, they did. They're out, and a bunch of folks replaced them. The index has never, in my view, been more important than today because of how dynamic and quickly industries are changing with AI. Use the index. Don't try to pick the horse. Don't try to pick the needle in the haystack. Own the whole stable, own the whole haystack. Let's talk artificial intelligence, how we're using it, what we should be wary of. It's gotten better, listener. I've gone ahead and ponied up for Gemini's paid service. So I'm using their thinking model. Their 3.0 Flash is free, so anyone can use it on the Gemini app. But they've got a thinking model now that does a little better job with the hallucinations. You've probably heard of these where you're giving it a problem and it'll make up something that it shouldn't. Well, this thinking model actually mitigates that and corrects for that. So I love it, believe it or else. Clients will come in with kind of an AI conversation and they'll bring it to the meeting and say, hey, this is what I'm thinking. I think it's all to the good. It usually, I've only seen it elevate the conversation and accelerate the thinking because the AI is usually at least directionally correct. Maybe the execution the AI doesn't fully appreciate, but usually directionally the AI is correct. Where can it go wrong? My experience is it's when we fail the artificial intelligence, it goes wrong not when there's usually not as many computational errors today as there were a year ago. What do I mean? I was looking at a Roth conversion strategy. Very reasonable, permissible strategy. What folks do is, let's say you want more money in your Roth. Great, but you've got money in a traditional IRA or traditional 401k. In a lower tax year, sometimes that's retirement for people, sometimes it's just a lull in their income, folks will move income over. They'll roll over a portion of that traditional IRA. It's fully taxable, that portion you roll over. You put it in a Roth, and as you may know, the Roth doesn't have required minimum distributions or taxes on it, whereas the traditional IRA has what are called those RMDs, those required minimum distributions. So the AI actually beautifully lays out the case, the pros and the cons. Now because I work with humans, know that any strategy any of us embark on, it requires execution. So unless a strategy really, really benefits someone and we can, beyond a shadow of a doubt, prove it, I'm not as ginned up about engaging in that strategy. I like things that you can do it once and set it and forget it. A Roth conversion strategy, because you're trying to sometimes fill up these tax brackets. We have a progressive tax code. So you want to roll over a certain amount of money, maybe up to the 24% bracket or the 32% bracket, because you want to maximize the tax efficiency of your strategy. Where could the AI mess up? Where could it mess up? If it doesn't know you well enough. That's its only blind spot now. It's getting so good at everything else, it messes up when we don't equip it with the right information. So for this Roth conversion strategy, there is a variable that matters quite a bit, which is life expectancy. So you're making a trade with the IRS. There's usually no free lunch. So if you are rolling over monies from a traditional IRA to a Roth, you're paying the tax today on that conversion up to your progressive tax rate. And that trade works out if the money's able to stay there for a long time. If it's not going to stay there a long time, you really aren't doing yourself a lot of favors. You're just paying the IRS very promptly. If the AI doesn't understand when you expect to pass away, which very few of us do, but at least equipping the AI with this information, it makes it a little less obvious that a certain conversion strategy should work. So the lesson here is use the AI more and more. Be sure we know what to ask the AI and what information to provide the AI. Because I see a big risk today. What's the risk today? The AI is confident. It does not say, I think, I hope, I'm not sure, but I maybe. They have programmed these large language models. They're pretty confident. And so I get it. You kind of read an answer and you think, wow, this is going to be just as right as rain. How could it be wrong? Be willing to fill the AI in and say, let's say it gives you an answer that you think is 100% sure. Give it more into context. Say, hey, I'm this many years old. This is how long I think I'll be able to have it in there. Whatever scenario you're proposing to it, because that's what's going to give you the right answer. And then for those of you bored of index fund investing, I know many of you may be struggling with that. Did you know your podcast host sometimes struggles with that too? I think, these indexes, fuddy-duddy. What I will do from time to time, and I recommend this prescription for you as well, particularly as the AI machine is going, all these dynamic companies are being started by venture capital, and particularly American companies are so dynamic. I was scratching my head going, what am I doing with international indexes? Even though I'm supposed to do it January of every year, I force myself to invest because I'm a born market timer. I was born this way. So I've set up rules for myself so that I don't try to time the market and hold cash. That's right. Every pastor needs to listen to their own sermon. So I did that. I just had a conversation with the AI. I said, hey, what's in the international index, and to what degree are the top 10 holdings in? I used VXUS, which is the Vanguard ETF. There are a couple of them, but that's one of them. I said, of the top 10 companies, how are they using AI? And it made me encouraged. A lot of dynamic companies internationally. A lot of companies are doing a lot of great work. As you know, last year, international had its breakout year. Finally, 17 years of lagging the U.S. It beat it last year. But be willing to do that. Oftentimes, it's my belief that index fund investing is boring because it's not researched. It's not dug into. We look at the wrapper, not the candy on the inside. Every now and again, go ahead and look at that Werther's original on the inside. Don't just stare at the wrapper. The index fund's the wrapper. Open it up, look at it, look under the hood. Dynamic companies within that you get to be a fractional owner in. And that's all to the good. And so as you think about index funds going forward, don't remember why we do it. It's because we want to keep our costs low, investing simple, and time horizon long, because that is what's going to give us the best shot on our investing journey. Until next week.